Hey YouTubers, Mike Martin's here, Mike Martin's channel. I want to thank everyone for joining me in another housing crisis video, and I want to thank everyone for their patience in the diversifying of my channel. I'm going to do housing crisis, my trends in the housing market, my rants and lifestyle, but I got to keep it some sort of a balance. So what I did was I've been doing video game reviews, and I noticed that the one strike I had left is gone. I have no strikes. I received an email that I'm free and clear now. I have no strikes. So I've been trying to keep the channel as PG as possible from it getting flagged. And I'm trying to really talk around certain subjects. So the video game reviews I'm doing don't get a lot of views right away. They usually build up over time. And it's kind of good this way. There's a balance in the channel. So I want to thank everyone for not unsubscribing for me, because in my heart, this housing problem is one of the biggest problems we're having. No one's looking at the financial shape this country is in right now, and it's really scary. So Better Dwelling has an article here, and I want to share it with you guys because it's really good. Canadian real estate debt passed 76 points of GDP. Here's the new problem we have. Now, I really like this article a lot because it kind of explains some of the basics for people that are trying to come to grips or understand what's happening right now in the housing markets. It all adds up in the end. Like, before we even get into this article, it's all cheap money. Cheap money, and a lot of the stock markets are doing well right now and pushing up the markets because of a ton of mergers and acquisitions are happening right now. And it's your typical, the rich get richer and the poor get poorer, people using equities from their homes to put down on other homes. And it's kind of a merge, because homes now are considered what you want to call commodities, not assets. So it's just like trading in the markets. And when there's a crash, people need to come to grips that they took a loss, you know. I took a small loss back in the day. I timed the market. I shouldn't have. I invested in Nintendo when that Pokemon Go thing took off. I should have sold at the right time, but I held. And that was, you know, you win and lose. And I go in willing to take a loss because that's just how business is, right? So with housing, the problem is it is the most important and the most expensive asset most people will ever buy in their lifetimes. So, and the problem is, people right now, I'm thinking from what I'm gauging from what the articles I'm seeing and the way the trends are being pushed, a lot of people have spent anywhere from 12 to 16 more times than what they're making. And in some countries like Australia, it's like in 18, 20 more times than what they're making. So, that's net, though. That's net. Because everyone's like, oh, yeah, you know, I make this gross. Big deal. Slash that in half. Give half to your local government, and that's what you make. So, here goes. Canadian real estate debt passed 76 points of GDP. Here's the new problem we have. So take a look at this, guys. Canadian real estate buying may be slowing down, but the long-term problems are just starting to brew. Numbers from the Bank of Canada, BOC, show that mortgage debt is ballooning as interest rates make minor upticks. Mortgage debt is now at the highest ratio compared to the economy it has ever been. Even though the debt service ratio are manageable, remember, secondary mortgages, riding off the coattails of your equity to help manage your debt and service your debt, that's what's happening. It's created a complex problem that almost certainly won't be a happy ending. Gross domestic product versus mortgage debt. There's two things you'll need to know today. Gross domestic product, GDP, I talk about it all the time on my channel, and mortgage debt. GDP is the value of goods and services produced in a country, which, more bluntly stated, is a broad measure of the economy. Increases don't necessarily correlate with wealthier country, in my opinion, but it's the best general measure we have. Mortgage debt is pretty self-explanatory. It's the amount of outstanding debt on residential real estate. Okay, so I'm gonna read that one more time. Mortgage debt is pretty self-explanatory. It's the amount of outstanding debt on residential real estate. So what's not they don't care about what's been paid in. It's what's outstanding. Okay. Mortgage debt is now the equivalent of 76 points of Canadians' GDP. That's huge. Mortgage debt is at the largest it's ever been in contrast to our GDP. The end of Q3 2017 saw the value of outstanding mortgage debt reach 76.27%, the value of our GDP. That's up 47 points since the Great Recession kicked off in 2007. I know, that means nothing to you if you're just a home buyer or trying to understand the economy. Don't worry, we'll break it down. And that's why this is a really good article. And Better Dwelling always does such a good job when it comes to explaining things to people. This is the mortgage debt as a percentage from gross domestic product. So here it is right here. Here are the quarters. So that's percentage of mortgage debt, people. Pay attention, okay? So there it is right there. That's huge. We're in Q3. That was recorded from Q3 of last year. Now, mortgage debt is accumulating faster than the board measure of the economy. We need to go back 12 quarters to find where the GDP growth is higher than the mortgage debt growth. So we're spending more in total as a country than what we're making, okay? Going back that far, we only find one quarter. We need to go all the way back to 2001 to find the actual period where GDP grows consistently higher than mortgage debt growth. Remember, I've been saying in my show for the longest time, I think I've been saying this for about 5-6 years now, that the Canadian economy, the Australian economy, the New Zealand economy, the UK economy, and some parts of America, Western America, like California and stuff, their economies are propped up on real estate mortgages. Their economy is backed by real estate mortgage. And this is why our housing market hasn't crashed. Our housing market hasn't crashed because it's tied to economy. And I said this before and I'll say it again. Markets crash within hours and days, but economies take a long time to crash. And that's why it's taken a while. Canada's GDP versus mortgage debt ratio. So here it is. Here's the mortgage growth, and there's our gross domestic product. So, and I keep saying in all my shows, and like a broken record, we need to create, fabricate, produce, export. A country's value and a country's wealth is purely, I think in my opinion, is based off what it ships out, exported out of the country. You know, I'm not talking about exporting our water. That I'm not going to flag this video by saying names and stuff, but a company was giving free water pretty much to an Asian country, and that's been and I'm not talking about export that. I'm talking about like making cars. I'm talking about making fans, ceiling fans, making fridges, making everything under the sun. Not only assembling and making the fridges, but fabricating and making the parts in-house and actually creating jobs, right? There's a reason really smart, and wealthy people are hitting on the Canadian housing economy. No, it's not because they're jealous of your wicked 400 square foot condo with a combination kitchen, bathroom, and bedroom. That's now worth a cool million. It's created a problem that's getting worse. What to do with interest rates? The complex problem that's getting worse. Monetary policy isn't as complex as your high school econ teacher made it. It's just difficult to make the right decision at the right time. Interest rates are lowered to stimulate demand. That's quantitative easings, right? Quantitative easing of interest-sensitive expenditures. That's fancy pants for house, cars, and other super expensive items that need long-term financing. This weakens the dollar. Interest rates are raised in order to attract capital inflows in pursuit of higher yields. The increased capital inflow leads to an appreciation of the Canadian dollar. Central banks are still pretending they don't know that lowering interest rates lead to inflows. They end up in places like urban land banking, and that's a topic for another day. So here's the percentage of income required by households to service their debt. So that's right there. There's the velocity of M2 there. Pow. And then there's Toronto. I think that's going to say Vancouver there. Oh, recession. That's right. Right there. So I think we've been in a recession for the last 10 months now. Maybe 15 months. Actually, 15 months we've been in a recession. I think we'll be in a depression. Kicking off into a depression after Q1. I don't want to be all fear porn and trying to scare people, and I just want people to make the right decisions in life when it comes to buying a house, because it is, again, and I'll say it again, the most expensive investment anybody, usually 95% of the people, will make in their lifetimes. So it's very important you make the right decision with this, right? Mortgage debt levels are now so high, it's hard to do anything without setting off a bad reaction. Rising interest rates will require households to spend even more money to service that pile of household debt. This, in turn, would reduce the free capital available to spend in the economy. So we're no longer spending in our economies. But in a way, it's okay. Well, I'm not saying it's okay in a way, because we're not even producing the stuff anywhere we're buying. We're just importing it in. I can understand if everything's being made in the country, but we're no longer buying from ourselves anymore. We're not even doing that. So, and so it goes in, the article continues to say, this in turn will reduce the free capital available to spend in the economy, like compressing GDP growth. That's bad. But we would get a stronger dollar, and that's sweet foreign capital to bolster the productive aspects of the economy. Leaving rates lower will prevent GDP compression, sending debt levels higher, and sending the dollar to perma-weakness. Lower interest rates levels will further stimulate demand for those interest-sensitive expenditures you learned about, aka House of Cards. Ponzi scheme. However, capital inflows won't end up in the right parts of the economy, weakening the Canadian dollar even further. And that's so true. So true. That whole trickle-in effect, I'll call it a trickle-in effect, trickle-in effect, because it's got to seep up into little cracks in the economy that help bandage what we got going on right now. And the bandages are falling off right now. Will Canada take higher home prices and a weaker dollar to continue the growth of the housing economy, or face the very real consequences of such a poorly structured economy and face half a decade of suppressed economic growth? I'm going to leave it with you guys in the comment section. I really want to know what you guys think about this. This is a very, very... Who wrote this thing? It's Stefan Panwasi, co-founder and chief data nerd at Better Dwelling. Stefan, good job, buddy. I like this article a lot. Very well written. I'm very happy, and it's an absolute privilege to read this to you guys. I feel that this actually covers pretty much all the bases up until now. I looked at 5-6 different articles hinting at different things, but Better Dwelling is king when it comes to disclosure. Thanks for watching, guys. Comment below. Let me know what you guys think in the comments below. Big hug.